Hello everyone, this is Juan Sarmiento and today is Friday, July the 7th. Let's take a quick look at our positions from the IRA perspective so you can see the actual value here. The positions, we have quite a few, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 positions. We have closed 2, so we have 10 left over. And well, what is our option buying power? Is enough for one more trade if we want it. I didn't see anyone in particular that would interest me. Okay, so what I want to do is let's go by symbol here, organize them alphabetically, and see what needs to change. Click on any of the trades, and if you have this yellow or any of these icons, you can go to the Analyze tab, and provided that you have a yellow icon here too, then you get to see the trade as it stands right now. If you deselect the shares, you see what that option looks like. Okay, this is the plain option short that you have, and you can see what the remaining value of it is. Currently we have $179, 181, but we can get as much as 357. So yeah, there is plenty of value. The option is due to expire next week, so next week we'll deal with it. Okay, by the way, go to the monitor tab, go to back let's say 100 days, so you can see how many the trade you have made. Look at this. We started our position here back in May, and at some point the option expired, worthless, and then I sold another one at a higher strike price a few days later. Okay, so then you simply adjust the value of your trade, and let's do that with a calculator. You have your original price was 31.75, and by selling the option here we had a credit of $1.49. Okay, so this price is reduced by $1.49, and this is the value of the trade now when you adjust it. So let's analyze that. Okay, and you can see that says 34, but now it's 35, so we are going to adjust this to July 14th at $35, and I place my price here. That's my current price. You can see that the stock says 33, but the 2 calls have reduced my actual break even, my actual price of the stock, my value of it, the price I paid, to $30.26. Okay, so here we are at a week to expiration, and we're right here sitting very close to my break-even point, to my maximum profit here, to my strike price of 35. So that looks excellent. Okay, and you can see what my profits has been on this one has been $1,239. Wow, this is fantastic, but I am expecting to make more. So in 2 months we already have we could make $1,400 in profit. Let's move on to COIN. Okay, this stock has moved so far up here that you know, the profit is fantastic. It expires today, but it's in deep value. That call is deep value. So what are we going to do? Well, look at the price here. Oh, this needs to change. That's why it was giving me an excessive value. I needed to change this to August 4th. Oh, okay, that's more. Yeah, this was more than I thought. Okay. Yeah. So my profit, that expected profit is 11.70 for the two trays, which is, it makes more sense, about $50. Okay. All right. So what are we going to do? Not much we need to do because we still have until August the 4th. However, if you look at this here, the difference is $300, no, $30. So you can always roll it up if you want to. Right? As it gets closer, my option, the higher option, would have no extrinsic value, so you can sell something with more extrinsic value. Okay, so here we could still make another $40, $42. Okay, so this option here that I own, you see it has lots of extrinsic value and lots of intrinsic value. So we want this $3.37 to go to zero. When that's zero or close to zero, we can roll it up or down. So I'm going to leave it for now. Okay. Let's move on to Etsy. July 21. Okay, so this expires next week, and we see that the value here. Let's first show you the plain call is right here. Okay, so there's still eroding the value. When that value, this magenta line meets the cyan line, yeah, we can roll it down. You can see that the stock is trading at 83 and my price was 90. Okay, there's still plenty of value here. Look at the option that you have shorted, and what is the extrinsic value of it? 88 cents. When this approaches zero, you can roll it down. Okay, still plenty of value there to expire, so I'm going to leave it alone. Let's move on to KSS. Here we have 7 days to expiration. Look at the extrinsic value. You have 24 cents. Okay, so that's for next week. We will deal with this next week, but we want this value to be zero. If it's zero, even at this, because the stock has gone down too much, you want to roll it down to get more value from that option. Otherwise, the stock could keep going down forever, and all you're doing is trying to catch up. So you will sell calls as it goes down. With every option going to extrinsic value of zero, you sell a lower option. But hopefully, or not hopefully, but at some point we'll deal with it. Let's go to MOS, and here, what is my option? Expiration, this is 14 days. Again, just look at the extrinsic value, 34 cents. Okay, moving on to MU. Look for your option. I can put here, instead of 50, let's put 10. Oh, this one, I had the option. What happened here? Okay, I'm gonna have to, it seems like I only have the shares here. Okay, 68. Let's go and take a look at our trade here. Well, obviously, MU, it says June 30th at 69. Well, this option was expired because the stock went down, and we missed the opportunity to sell a call on this right after June. Essentially on Monday I could have sold a new one. This expired on Friday, June the 30th, and now a week later we could have sell some option on Monday. Let's take a look at the chart. How badly did we do? Yeah, it's been going down significantly. You see that? Okay, so here was the 29th, came down the 30th. It kept going down. See, on Monday we could have sold a higher option, but in any case, what we're going to do is sell what we can sell with about 30 days to expiration or 35 days to expiration. Yeah, how about the August 11th? Look at the option we're going to sell here. The one with 0 intrinsic value and the most extrinsic value would be this one here at 62. I click on the bid and all I have to sell is the 1. Okay? It's not much I'm recovering from there. Obviously, I was hoping that it would be taken away. It wasn't taken away. Okay. Let's do that. Oh, if you want, you can look at this from this perspective. We analyze that. So the new trade will be the new trade is 223. Let's say calculation. Okay, so the price I paid for my other option was 64.87. Okay, and I'm selling this option for 223. So this is my actual price after adjustments. So I'm gonna copy that and put the 11th, August 11th here, and this is my price, my new price. And my strike price for my option is 62. And then we hide everything, hide the position, hide this short, and this is what it would look like, my new trade. Oh, now I'm below. See that? I'm below. So because it's going down, the value of my shares have decreased, but I have been adjusting my calls, or I would be adjusting my calls so that my actual price is here. Okay, you see that? It's a little above my price, what I paid, but a couple more options and then this price will be even further down, and then we'll be making money. So don't be afraid. You are getting some of those calls, and that's the point. The stock will go up and go down, but the option is always going to go to 0. The extrinsic value of the option is always going to go to 0, so you're always recovering that. This is not exactly, I'm not getting a lot of credit for it. I'm only getting $225. That's not a lot. The stock is 31, 33, so the volatility must be really, really low now. Yes, it has fallen, so I'm not getting a whole lot for the option. Okay, I waited after the earnings and the volatility drops. That would have been the time to get out right here at the opening of that day after earnings, because the volatility begins to decline, and you take advantage of that. Okay, so let's do it anyway. Hopefully the volatility will increase in the future, but I want to keep doing this for educational purposes. Otherwise, just get out of the trade. Okay? It didn't work, but I want to show you that eventually it does work. You do recover your profits. You do recover your value. And I just wait until it gets filled. Okay, let's move on to Roku. Okay, that was new, just got filled. Good. Let's go to Roku. Roku is August the 4th expiring, and you can see that the option alone still have plenty of value. Okay, yeah, so the trade itself has given me some value, 698, but I want to make 1200 and some odd dollars. Go to the monitor tab and you can see here that we have two trades, the original and the adjustment. So it's a debit, so my cost increased, but I'm actually getting more value, extrinsic value, by rolling up the share, which is what I did. I bought back my 57 and bought 64. So you take these two numbers, take those two numbers. The original cost was 52.82. Okay, but it says here that I paid to have the roll up. That means I bought back the cheap option, and I mean the deep in the value option. This is the expensive option because it has more intrinsic value, even though it has no extrinsic value at the time of expiration. And 64 is a higher stock, so it's a higher price. So you're paying more for that option, but it also, I mean, you're essentially paying less because it's closer to in the money. So you're getting less and you're paying a lot for this one, but you're getting extrinsic value, more extrinsic value. So it's a debit in the end. So what happens is you need to add that to my value. So the 52.82, we add $1.45. How you know you need to add when it says debit here. That means you paid for this. Okay, so 54.27 is the new value, the new cost for me. I put that price here, and you can see that that's the adjusted. And this is what it will look like now. And you can see that I could make $973 if the stock does stay above 64. Okay, let's move on to SPWR. This stock has been going down dramatically. Okay, so then let's say we show all, and you can see that I already rolled that up, meaning I sold a lower strike price because the value was close to zero of the option. So here you have a credit, so 7.79 is less. Is the reduction. So the calculator, my original price was $10.60, and I got, because I roll it down, I got a credit of 79. So I'm going to subtract that by 0.79. My new price is $9.81. Okay, and that's what I have here. Adjust that to August 9.5, and I put that number here. Okay, even if this is not a winner, eventually it should become a winner. So you keep on playing. There should not be losers. The only way you're gonna lose definitively is if the stock goes down to zero so quickly that you can't sell many calls in between, goes to zero, and now you don't have any value. Okay, let's move on to WDC. And here we are, and this expires today. Okay, good. So we're going to close this. So I'm going to analyze rolling. The only question is, what am I buying back? I'm buying this option that I have. What is the extrinsic value? Zero. That option can be expired worthless, but I want to close it, even if it is at 1 penny, and I want to sell something with 30 days to expiration at, let's say, August 11, 35 days, and I look for the intrinsic value of 0 in the extrinsic of 1.151. So what option is that? August 11th on the strike price 39. And that option, we have 3, okay? So it's important to calculate how much of an extrinsic value are we selling. So you take the extrinsic value here, 1.525, and we're going to sell 3 of those. So times 300 gives you $457. That's how much you're going to get in extrinsic value for sure. That will go to 0 regardless of the stock price. Okay, so sounds great. It's not ideal. If you can get 500, you would be the happiest, but look at this. Okay, let's hide the current position. This is the existing trade here. Okay, my new trade, my return will be $840 if it stays above 39. Okay, if it goes to a little higher than 39, which is right here. Okay, and even though the extrinsic value is $1 and whatever it was, I get only a credit of 33. That's because, well, I need to change this, I'm sorry, to August 11th. Okay, so my maximum potential profit is $11.85. Okay, that's good. I want it to be 2 months, $1,000. That's fantastic. But $11.85 is even better. Okay, so here is my credit. Let's put it at 1.5. 1.5 times 3. So 1.5 times 300, yeah, $450. But it was going to be more than that because it's the extrinsic value that I'm keeping. Okay, let's do that. Send that off. So you see the strike has been reduced. And let's go to X. Okay, so 25 is my price. This is to August. Yeah, I'm not going to change anything. If you want, in doubt, just deselect everything and just show the option. And this option should be touching. The pink and the blue should be very close or the same. All right, and that's all you need to do. All right, we're going to do the same trades that we have done here today. We need to do them also in the margin account. So let's take a look. A new. I say analyze. Yeah. Let's say, oops, let's go to the activity and let's copy that. That's my short, and on the margin account we haven't done that put. That call, sorry, sold that call. So confirm and send. So we are doing the same in both accounts, the margin and the regular account. And then let's do the same. Okay, that's the new field here. Good. Let's go to the all accounts and show we have the WDC, create duplicate order and put it into the confirm and send it to the margin account here. Here we go. Okay. And then the rest is just waiting for these guys to get filled. I could adjust my credit here. Cancel replace. You see, it could be anywhere between 1.41 and 1.51. So I'll give it a few minutes, and if it doesn't get filled, I begin to reduce it by 3 cents at a time. Okay, other than that, if you go to the account statements on the IRA account, we have 5,000, you can see the profit here, P&L 5,376.50. It should be about the same in the IRA account, but we really have invested here $100,000. On the margin account, we have half that much, but it allows you to accumulate. So on a percent basis, the profits is much better. There is a risk to it though. If the stock price of any of these positions goes really low, you may get a margin call and have to provide additional funds. Okay, so it's not all good and dandy. You have to be careful about that, or at least keep the additional 50,000 in a savings account of some sort. Okay, that's all for today. Thank you very much for joining me. See you next time. Bye-bye.